So today I've got 18 questions for you, which is going to seem like a lot, but I promise stick with me. The first 17 questions can be pretty transformative, but the 18th question, I hope, will just blow your mind, feel like it comes from outer space, be just out of nowhere. And you got to get those first 17 down before you ask that 18th and really have some fun with it. I do promise I did an episode with our friends over at the Not Your Average Financial podcast about this topic. And it was like an hour and a half, I think, definitely over an hour long. I promise this one will be way shorter and hopefully still be as transformative as that episode was that we recorded, I guess, over a year ago now. So, welcome to the FIFE Movement. I'm your host, Amanda Neely. This is the only movement that helps you create your unique, feminine, and entrepreneurial approach to financial independence. Please be sure to subscribe. I've got a lot of great episodes coming up that I know you don't want to miss. So, let me give you the background here. A lot of people, when they're looking at whole life insurance, the way we do it, sometimes called bank on yourself or infinite banking, properly designed, all that. It's kind of a Roth alternative. And as many people love the Roth IRA, it is a pretty awesome financial product. Was invented in the 1990s. I forget exactly which year, like 96 or something like that. So it's not very old. And of course, you're limited. You can only put in 6,000. You can only put in money when you're actually earning income, things like that. So it's not perfect, but it is pretty awesome. Same with the whole life insurance side. It's pretty awesome, but it's not perfect. There's some pros and cons to it. Or maybe it is perfect. Your decision there. um, maybe it's perfect for some people. So we tried to do this side by side comparison, and let me show you. I've got a couple things to show you on my screen today. So if you're catching the podcast version of this, please check out the YouTube one. But when we did the episode with our friends over at the Not Your Average Financial podcast. It was recorded live. We went through this awesome spreadsheet that, if you're watching YouTube, you're seeing right now in terms of we set aside the properly designed, high cash value dividend paying whole life insurance side by side with the buy term and invest and use a Roth, right? And we went over in so much detail where all these numbers came from. But as we go through the 18 questions I have for you today, I want to kind of come back to the spreadsheet to see how we might find some answers to that question. But if you want to dig into where these numbers come from, what they mean, look for that link in the description below to go check out that longer episode. Okay, so here's what I think. Here's my 17 questions, and we're going to just kind of go through them a little bit. And if you want a copy of this to fill in for yourself, do your own research, please just reach out to me. I'm happy to send this document to you. So, first question: what happens if you need or want your money prior to age 59 and a half? With a whole life policy, you've got the cash value there. You can use a loan based on your cash value to, use it for whatever you want, no questions asked, right? No credit to pass, nothing like that. With a Roth, those funds are locked up until you're 59 and a half. There can be a 10% penalty. Maybe actually, Roth IRAs do not have, I think, a loan capability to them. So your funds are for sure locked up until you're 59 and a half. You can't access them. If you need to go buy a car, you've got to either save up cash somewhere else, you got to borrow from the bank, you got to lease a vehicle, like whatever it might be, or a down payment on a home, all kinds of different things that might come up. Kids' college, you're stuck. You can't use your Roth IRA for that unless you have some kind of hardship, and then you've got to go through all these hoops to jump through and things like that. So on this side, this question seems pretty clear, right? What if you need or want your money prior to age 59 and a half? Now, on my example, I used a 35-year-old female. I was 35 at the time when I did that. So I kind of asked, what happens if the stock market goes down significantly when you're 36, right? So like a year after you start. With a Roth IRA, you've got plenty of time to recover, right? You're probably not going to touch those funds till you're 59 and a half. Over 20 years, you've got for recovery. Although if you look at the volatility and how much it eats into your growth, that can still be a serious consequence. I've talked about that in past episodes, probably will bring it up again. Like the downs aren't something to just be like, well, it'll bounce back. You got to think about how it is actually impacting you overall. Whereas the whole life policy, it's not impacted when the stock market goes down. You continue to get the same guarantees, and the dividends are very predictable. So you're not impacted. Same with when you're 60, although with the Roth IRA, then that's my next question. What happens if the stock market goes down significantly when you're 60? With a Roth IRA, you don't have time to recover. You've got to figure out, do you sell when it's low? Do you go ahead and use the money when you know, when it's down? Do you try to, find somewhere else that you can get money from? What do you do? Whereas with the whole life policy, no questions, you can still use it when you want. Maybe with the Roth, though, you have to delay your retirement, or, there could be all kinds of consequences there. Um, Now, what happens if the stock market goes down significantly when you're 30, or goes up significantly when you're 36? This is where the Roth, you'd be like, yeah, I put in my money and boom, I've got a lot more. Look, I was so amazing, right? A year later, right? From when you started in my example. With the whole life, you're still going to see the same predictable, steady growth. You'll be like, I probably missed out on some stock market stuff that I thought I would do. But you don't know when you're starting a year earlier, right? What is going to happen? But that might be your reaction. But then what if the stock market goes up significantly when you're 60? You might be really excited about that in your Roth, right? You're about to retire, or, be able to use those funds. You just got a huge return. You're going to cash out when it's high, right? Whereas in the whole life, you're not really going to see that, right? It's still going to have that guaranteed and predictable growth if you're with the, right insurance company, stuff like that. But here's a fascinating thing a lot of people don't remember. Go back to question one. What if you need or want your money prior to age 59 and a half, or any time when you're 60, whenever? Guess what you could do? You could go take advantage of some of those ups and downs in the market all throughout your lifetime. You don't have to just use the cash value to go buy a car, a down payment, or pay for kids' college, like whatever. You could go put it to work and investing in the market to take advantage of some of those opportunities as well. So you're not like limiting yourself. Okay. Now, are there any guarantees? With the Roth IRA, at least, you're I don't know of a guarantee there, except maybe that you won't be taxed on the money in the future, but that's not even a guarantee because they could always change the law, and you could be taxed on your growth in the future. They could be like, this Roth experiment, it was good while it lasted, but we're done with that. Now all your growth is taxable. Congress could totally do that. The Internal Revenue Service could do that. Whoever would do that could do it. So there aren't really any guarantees. Whereas with the life insurance policy, you do have some guarantees there, as long as you're working with a reputable life insurance company that can back up those guarantees. But even if something happened to that life insurance company, there's a whole layer of safety nets that get really technical. I don't want to bore you with all of those, but if you want to know them, please reach out to me. I'm happy to share. So yeah, you get some guarantees with the whole life part. Is the amount going in each year flexible? With the Roth IRA, 100% flexible, right? Some years you could put in your full 6,000, other years you can't. You don't have to, right? There's no penalty if you don't put in any money, or if you just put in $50 or whatever it might be. But the amount also, you can't go above 6,000, right? There might be some catch-up provisions in your 50s, but really you're still limited. There's still a pretty big ceiling on it. With the whole life, on the other hand, you do have kind of a minimum you want to aim for each year to cover the policy. But it is flexible. You can go up and down with some of your premium. And even if you can't put in any money, you can use the cash value that's building up to pay your premium for you. So there's some flexibility. You just wouldn't want to do that every year, right? Um, but the really cool thing is that you can always start, if you're on the flip side, you want to put in more money, you can always start a second policy or a third. Or there's people that have 20 some policies. Whereas a Roth, you're limited to 6,000. No matter if you have like 3 different Roth accounts, you can only put in that 6,000, right? Each year. So you have that ceiling no matter what. And then, so yeah, what if you want to put in more or less? I guess that question's the same um, as the previous question, but particularly with the more, right? Being able to put in more. Also, with a Roth, you're limited. You can't put in money if you're not earning income. So if you're living off passive income or you take a sabbatical from work for a year, something like that, you can't put money in there. Just a heads up. Tax consequences. So when you both of these, you're putting money in after you've paid the taxes on it, and both of them have ways to use the funds without any tax implications on the growth, at least under current law. So here that they're the same. That's part of why they're often side by side comparison kind of thing. But and then before you're 59 and a half or after you're 59 and a half, the taxes are the same, but with the Roth, you got to watch out for that penalty, which isn't really a tax, it's a penalty, but it's still the Internal Revenue Service, right? That's assessing that. Again, when you use the money, you don't have to worry about taxes either, at least under current law. What if you get cancer or some other chronic or terminal illness? This is one thing that's not talked a lot about with whole life. The really awesome companies that I love, they offer what's called an accelerated benefit rider, where you can access a portion of your death benefit if you get a diagnosis and need to cover medical costs or have a nurse come help you at home or whatever it might be. So I think that's a pretty awesome benefit that the amount you can access is usually more than your cash value is. So it gives you the ability to help pay for that. Whereas with your Roth, you would need to use those funds. And if the market's down, you'd have to sell when the market's down, right? Unless you've got something else like a long term care insurance policy or something like that. But with the Roth in particular, there's no like bonus if you get cancer or a terminal illness. You just have your funds, they're doing their thing. What happens if you get sued? This is another thing that's not talked a lot about with whole life. There are some protections. They vary widely depending on what state you live in. So you'd want to look at how much is protected in case you get sued in your state. But it's protected, because life insurance is really about protecting widows and widowers and orphans, right? And they want to make sure that if you get sued, that your family is not impacted by that. Whereas a Roth IRA isn't protected in the same ways. And then what happens if you die too young? When you have your Roth IRA, hopefully you get some term insurance to go along with that to help protect you while you're young. And maybe you're able to purchase more because it's not as expensive as whole life. I'm going to come back to that expensive thing. But at the whole life, you might have a lower death benefit. So maybe it is better to do term and then invest in a Roth IRA. But what happens if you die too old? The term expires or gets more expensive when you're older. So you often people cancel their term. Whereas on the side of the whole life, it's there for your whole life. You can stop making payments and you can still have it for your whole life. Um, and then what would your heirs receive when you pass? With the whole life, they receive your death benefit. With the Roth, they receive your account balance. And if you bought some term, they'd receive the death benefit on that term too, which could be more some years, but could also be less, especially after that term expires. What taxes would your heirs pay? In both cases, it's the same. The money goes to them tax-free unless you have an estate over a certain amount, then you might have estate taxes. But for most people, it's going to be tax-free, at least under current law. Now, I want to come back to this whole cost thing really quick before we look at question 18, because I think this is really important. I was just talking with somebody this week about this. So what you'll notice when you look at a whole life policy is whatever your premium is here, and I just use 6,000 in this example because it would match what we did with the Roth. You'll notice that at the beginning, there's this cost of insurance at the beginning, right? 1,500. And then over time, right, if we just select these, um, it takes a little bit of time for the cash value to catch up. So in this case, it took 9 years. 9 times 6 is 54,000. And here I've got 55,000 in life insurance. But I did have that almost $1,500 hit at the beginning. Like that seems pretty big. That's expensive, right? Whole life is expensive, and I'm only getting 234,000, whereas over here I get 475. That's a big thing that people is a big hurdle to get over. But I want to show you something very interesting here, right? We paid that 1,500 at the beginning, but by 9 years later, the costs of insurance have been outweighed by the growth of the policy, and now we never pay for life insurance for the rest of our life, really, right? Because we're getting so much growth in our policy, and that keeps going. Whereas here, the term cost is always there, and you keep paying it year after year, even if it seems, this first year it's way less, right? It's not $1,500. And in fact, if I go over here to my calculations, the cost of the term is only $700 a year, right? 697. And these are real numbers from real life insurance company, right? For me a year ago when I was 35. But if I look at that over 30 years, that's $20,000 that I paid for term. And if I can't pay the pay increase when I'm, what would that be, 65, or I don't want to, whatever, that's $20,000 that's now just gone. And there's no death benefit, right? In this case here, right? When I got to year 31, it's gone. And there went $20,000. Whereas here, I sacrificed 1 year, $1,500 ish. And by year, and it gets less and less as you go. I'm not going to bore you with all that math, but by year 9, I've got that back. Like, I don't know about you, but to me, that seems like a win-win, right? Like or a no-brainer, but you decide for yourself what you think. And here's the question. You can write other notes here, right? If you have them, but here's the 18th question that I said was going to come out of nowhere. For some fun, brainstorm what would the benefits and downsides of having both. What if you started a whole life policy and you put money there that you wanted to use before you're 59 and a half for vacations, cars, kids' college, down payment on a home, roof repairs, property taxes, like all the different things of life you put into a whole life policy. And then for retirement, what you might want there, you put that into a Roth IRA, maybe so that you can do a little bit of investing in the market, get some of those upsides, and like have the tax advantages too of that, right? Instead of just using a brokerage account or something like that, because they say want to invest for the long term. So I don't know, maybe that's a good idea. You tell me, what do you think are some of the benefits and downsides of having both? If you're watching on YouTube, you can do that in the comments below. In the if you're checking out the podcast version, please go to the YouTube and participate in the discussion there. Because I could see there being some benefits of not having to pay that $20,000 over 30 years for term insurance. You could, but still getting some of the growth in the Roth. Maybe if the market is going to grow, who knows? Over the next 30 years, it could not grow. Who knows? But also having the protection and the liquidity that the whole life provides. And then, you save that $20,000 of buying term, and you free yourself from having to depend on banks whenever you want to buy a car or, that kind of thing. Um, but there could also be some downsides, like, I don't know, this is $500 a month, and this is $500 a month in this example. That might be too much for people to put $1,000 aside, but for other people, it might be easier. Or maybe you look at, maybe you do 6,000 on one set on the whole life policy, and you decide anything extra, money I'm willing to lose, money that I'm willing to not touch until I'm 59 and a half. Maybe that's what I put in my Roth because I'm not required to put in 6,000. Or you find your own unique balance there. But maybe funding too might seem like a lot. That could be a big downside. But I want to hear from you. Brainstorm, tell me a little bit more. What are the benefits and downsides of having both? Okay, that was a lot for me today. Thanks for sticking with me and connecting with the FIFE movement. As you go about your day today, remember, wealth is coming your way. Your quest is to prepare for using it well. What kind of financial product do you use, right? Having these kinds of conversations, getting these kinds of side-by-side comparisons too, made for you. I would love to do that if you want me to. That's the kind of preparing for the wealth that's coming your way. For more tips on how to prepare, please be sure to subscribe, and to connect with the community, visit fifemovement.com. And if this video has been helpful to you, or you think it could be helpful to someone you know, please share it with a friend. My gratitude in advance.